Question 9. Why does the VAT system need to be reviewed? Answer. Value-added tax (VAT) is a major source of revenue for national budgets and is likely to be proportional, even more so as the economic crisis and aging populations take their toll on other taxes such as labor and capital. Many member states have recently increased their VAT rates as part of their consolidation efforts. Consumption taxes are considered in general to be a more stable revenue source and more growth-friendly than certain other taxes such as profits and income. However, the VAT system currently in place is not well fitted for today's society. It was designed over 40 years ago when services, modern technologies and globalization had a far less prominent role in the economy than they do today. There are numerous shortcomings in the current VAT system which create obstacles to the internal market, cause burdens for businesses and prevent member states from benefiting from the true potential of this tax. While fundamental idea behind VAT is to have a broad-based, globally applied consumption tax, the wide and divergent use of reduced rates and exemptions by member states means that only part of final consumption is being taxed at the standard rate. Moreover, inconsistencies in the application of reduced VAT rates also lead to distortions of competition within the internal market. Finally, the current VAT system is relatively vulnerable to fraud, and a significant part of the VAT is lost this WA. Taking into account the above weaknesses, the VAT system needs to be reviewed to ensure that it is as efficient, robust and flexible as it can possibly be. A reform of the VAT system could greatly contribute to delivering on the EU's 2020 strategy, strengthening the internal market and supporting member states' budget consolidation. Question 10. What does the Single Market Act say in relation to VAT? Answer. The Single Market Act sets out several initiatives to boost growth and strengthen the internal market. This includes creating a supportive legal and fiscal environment for businesses in order to reduce administrative burdens and promote cross-border activity. VAT is a key element in this respect. In its proposal number 20, the Single Market Act specifically mentions the idea of a new VAT strategy. The current structure of the VAT system leads to disproportionate administrative burden for businesses, whereas with the latest technological developments, their administrative obligations could be reduced considerably, especially with regard to reporting and collecting VAT. Question 11. What are the key issues that are addressed in the consultation? Answer. The Green Paper puts all aspects of the VAT system up for discussion and aims to get as wide as possible feedback on how to achieve a simpler, more robust and modern VAT system. The aim is to review the current regime in order to reduce collection and compliance costs, provide maximum flexibility for member states and protect against fraud. A first part of the consultation deals with the treatment of cross-border supplies, i.e. what would be the most efficient way to charge and collect VAT in intra-EU transactions. The second part concerns a wider array of key issues such as how to ensure tax neutrality, the degree of harmonization required in the single market and how to reduce red tape whilst ensuring VAT revenues for member states. Contributors to the consultation are also invited to raise any other issues that they feel might be relevant, which may not be specifically mentioned in the Green Paper. Question 12. What problems do businesses face under the current system? Answer. Businesses that want to operate cross-border within the EU face additional VAT obligations and must apply special VAT rules which do not affect businesses working only at domestic level. This creates higher compliance costs and administrative burdens for businesses working in more than one member state and can act as a deterrent for businesses, in particular SMEs, from taking full advantage of the internal market. Question 13. What makes the current system susceptible to fraud and how can this be addressed? Answer. Abolishing fiscal controls at the time of implementation of the internal market 1993 has been of enormous benefit for European businesses. The free circulation of goods within the EU has considerably reduced the administrative burden and costs related to cross-border activities. Nevertheless, the current European VAT arrangements are designed so that intra-EU supplies of goods between businesses are exempt in the member state of origin, with taxation taking place in the member state of destination. This exemption mechanism exposes the VAT system to fraud, in particular carousel or missing trader fraud. This is when a fraudster purchases goods VAT-free in one member state and resells them with VAT in another member state. The fraudster then pockets the VAT and goes missing, without declaring anything to the tax authorities in the member state of destination. One way of tackling carousel fraud is to implement a reverse charge system, i.e. making the customer responsible responsible for paying the VAT rather than the seller. The green paper seeks feedback from stakeholders on various options that could help to prevent fraud, such as cross-border reverse charge or taxing intra-EU supplies. It also opens a discussion on new means for collecting VAT, which would guarantee that member states get the VAT that they are due, prevent fraud and provide more legal certainty to businesses. Question 14. How much is lost every year because of VAT fraud? Answer. Although, due to the very nature of fraud, it is difficult to put a precise figure on VAT losses on intra-EU transactions due to fraud, it is thought to be several billion euro each year. In 2009, the Commission published a study on the EU VAT Gap 1, which compared what member states actually got in VAT receipts with what should have been expected. While this VAT gap covers more than just fraud, also legal avoidance and insolvencies, the study set the gap at €106.7 billion in 2006 within the EU 25. This represents an average of 12% of the net theoretical liability, although several member states were above 20%. VAT fraud does not only affect the financial interests of the member states and the EU, it also has an impact on honest businesses which find themselves unable to compete on a level playing field in those sectors which are affected by a significant amount of VAT fraud. Question 15. What has the Commission done to address the problem of VAT fraud? Answer. In 2008, the Commission set out a coordinated strategy to improve the fight against VAT fraud in the EU. This strategy included a series of targeted measures, including plans for legislative proposals, which have now all been put forward, and a longer-term reflection on how to fight the problem. One key element was to look increasing the efficiency of administrative cooperation between tax administrations, and establishing the legal base for establishing a network of national officials to detect and combat new cases of cross-border VAT fraud. This network, Eurofisc, is now operational and working to coordinate data exchange and establish an early warning mechanism to detect and prevent fraud. Some types of fraud require specific measures, and the Commission has worked to support member states in any way that it can to combat such activity. For example, when serious levels of VAT fraud were detected in the CO2 emissions trading scheme in 2009, the Commission acted very promptly, bringing forward a proposal for a reverse charge system which member states could apply to tackle this problem. Question 16. What are the next steps after the VAT Green Paper? Answer. The Green Paper on the future of VAT launches a wide consultation process with all stakeholders on the current VAT system and the possible ways to strengthening and improve it. The consultation will continue until the 31st of May 2011. On the basis of the feedback received, the Commission will draw up a communication before the end of 2011, setting out the priorities for a future VAT strategy.